This is the casino model that may be quietly reshaping Las Vegas and exposing a deeper structural problem the Strip can no longer hide. Why are locals increasingly choosing properties away from the Strip? Why is the cost of the Vegas experience rising faster than its perceived value? And who is really benefiting from a system where prices climb, but accessibility collapses? Because beneath the surface, something more dangerous is happening. A shift where affordability becomes fragmented and identity is slowly stripped away. This is not a future risk. It is already happening. Stay with me, because the real structure behind this shift is far more revealing than it appears. If you value clear, data-driven investigations like this, consider subscribing and turning on notifications so you don't miss what comes next. Sunset Station opened on June 10, 1997, developed by Station Casinos as part of a broader expansion strategy targeting the local Las Vegas market rather than international tourism. The total initial investment was approximately $100 million, positioning it as a mid-scale locals casino with a distinct identity. At the time, the vision was clear. Not spectacle, not global attention, but consistency. Station Casinos, under the leadership of Frank Fertitta Jr., and later expanded by Frank Fertitta III and Lorenzo Fertitta, built this property to serve repeat customers, residents, workers, families, people who would return weekly, not once a year. The design reflected that strategy. A strong Spanish-themed identity, warm colors, decorative tiles, a sense of place that felt intentionally different from the Strip. In the late 1990s, this model worked. The Las Vegas Strip was still evolving into a global entertainment hub, but locals casinos operated in a parallel system. Lower costs, higher frequency, stable demand. Sunset Station became one of the flagship properties in that ecosystem. But that was a different era. Today, nearly 3 decades later, the contrast is difficult to ignore. The Strip has transformed into a high-cost, high-margin environment dominated by luxury positioning and corporate consolidation. Meanwhile, properties like Sunset Station are no longer just serving locals. They are absorbing pressure created by the Strip itself. And more importantly, they are beginning to change in response. Not by expanding their original identity, but by gradually replacing it. Sunset Station is owned and operated by Station Casinos, LLC, a subsidiary of Red Rock Resorts Inc., a publicly traded company listed on NASDAQ under the ticker RRR. Unlike many major Strip properties, this asset has not been separated into a sale-leaseback structure. There is no external REIT controlling the land, no Vicky properties, no gaming and leisure properties. The real estate and operations remain vertically integrated. And that distinction matters, because it removes one of the largest fixed pressures seen across the Strip: long-term rent obligations under triple net leases. In those structures, operators are required to pay base rent, escalating annually, while also covering property taxes, insurance, and maintenance. A rigid cost base that continues regardless of performance. Sunset Station does not carry that exact burden. But that does not mean it is free from structural pressure. Red Rock Resorts reported total consolidated debt of approximately $3.5 billion as of December 31, 2023. A significant portion of that debt is tied to its portfolio of properties, including Sunset Station. Interest expense alone exceeded $200 million annually in recent filings. That creates a different kind of obligation. Not rent, but debt servicing. And unlike rent, which is contractually fixed, Debt introduces exposure to interest rate fluctuations, refinancing risk, and capital structure constraints. There is also ongoing capital expenditure. Renovations, modernization, repositioning of the asset. These are not optional. They are required to remain competitive, especially as newer properties like Durango Casino opened in December 2023 with a reported cost of $780 million, raised the baseline standard across the locals market. So while Sunset Station avoids the rigidity of a triple net lease, it operates under a different system. One where capital is internal, but pressure is still constant. Because the obligation doesn't disappear. It simply changes form. And that form still demands performance. To understand how that structure is holding up, you have to look at the numbers. Red Rock Resorts reported total net revenue of approximately $1.85 billion for full year 2023, an increase of about 6% compared to 2022. Adjusted EBITDA came in around $846 million, reflecting a margin profile that remains strong, but no longer expanding at the same pace seen in the post-pandemic rebound period. The Las Vegas Locals segment, where Sunset Station operates, generated the majority of that performance. In the fourth quarter of 2023 alone, the segment reported revenue of roughly $484 million, up approximately 2% year-over-year. Adjusted EBITDA for the same period was about $223 million, showing stability but also a clear deceleration in growth. This is where the signal starts to shift. Growth is still present, but it is narrowing. At the same time, broader visitor data adds another layer. According to the Las Vegas Convention and Visitors Authority, total visitor volume reached approximately 40.8 million in 2023, up around 5% from 2022. Harry Reid International Airport reported passenger traffic exceeding 57.6 million, also showing recovery. But those gains are not evenly distributed. The Strip continues to capture the highest spending visitors, while locals' properties depend on frequency rather than volume spikes. Gaming revenue trends reflect that divide. Clark County reported total gaming revenue of approximately $15.5 billion in 2023, with the Strip accounting for a disproportionate share of high-margin activity. So while Sunset Station benefits from steady local demand, it does not fully participate in the upside of premium tourism spending. And that creates a ceiling. Stable revenue, stable EBITDA, but limited expansion. A system that performs, but does not accelerate. And in a rising cost environment, that distinction becomes critical. This is where the structure begins to tighten. Because even without a triple net lease, Sunset Station operates under a fixed cost base that does not move easily. First, debt servicing. With Red Rock Resorts carrying approximately $3.5 billion in total debt as of December 31st, 2023, interest expense alone exceeds $200 million annually. That obligation exists regardless of quarterly performance. And in a higher interest rate environment, refinancing becomes more expensive. Second, capital expenditure. The property is actively undergoing modernization, phasing out older themed areas, upgrading casino floors, repositioning entertainment spaces. These are not discretionary upgrades. They are required to keep pace with newer assets like Durango, which opened in December 2023 with a significantly higher design standard. But CapEx creates pressure. Cash outflows today for uncertain return tomorrow. Third, operating leverage. Locals' casinos depend on repeat visits, high frequency, lower spend per visit, which means margins are sensitive to small shifts in behavior. If visitation drops slightly, revenue adjusts quickly, but costs do not. Fourth, pricing friction. The $39.99 amenity fee layered on top of a $79 base room rate introduces a structural tension. It protects headline pricing, but increases total costs. And once customers begin focusing on total cost instead of base rate, the perceived value starts to erode. That erosion does not happen immediately, but it accumulates. Fifth, depreciation and asset aging. A property opened in 1997 carries ongoing maintenance requirements that newer builds do not. Systems degrade, infrastructure requires replacement, design becomes outdated, all of which feeds back into CapEx and cost. And finally, the most subtle pressure point: identity loss. As the property removes its original Spanish-themed design, it reduces differentiation. And differentiation is not just aesthetic. It is pricing power. Without it, the property competes more directly on cost. And cost competition compresses margins. None of these pressures are catastrophic on their own, but together, they form a system under tension, not collapsing, but no longer expanding freely. A system that must now be managed rather than scaled. To understand whether that pressure is isolated or systemic, you have to look beyond a single property. And the data suggests this is not isolated. According to the Las Vegas Convention and Visitors Authority, total visitation reached approximately 40.8 million in 2023, a 5% increase year over year. On the surface, that signals recovery. But the composition of that demand is changing. Strip properties continue to capture the highest spending visitors, higher room rates, higher food and beverage pricing, higher per-visitor revenue. At the same time, Harry Reid International Airport recorded over 57.6 million passengers in 2023, but growth has begun to normalize after the post-pandemic surge. No longer accelerating, stabilizing. And that distinction matters, because a stable tourism base does not support unlimited price expansion. Meanwhile, the locals market operates under a different dynamic. It is not driven by tourism cycles, but by regional economic conditions. Household income, employment stability, cost of living. And those variables are under pressure. Inflation has increased operating costs across the system, labor expenses have risen, consumer spending is becoming more selective. At the same time, online gambling continues to expand in multiple U.S. states. It does not replace the casino experience, but it competes for discretionary spending. Every dollar spent digitally is a dollar not spent on property. So now the system is facing pressure from both sides. The Strip pushes pricing upward, while external alternatives pull spending outward. And in between, properties like Sunset Station must hold position. Maintaining value, maintaining traffic, maintaining margins. But the margin for error is getting thinner. On the surface, the system still works. Revenue is growing. EBITDA remains strong. Visitor numbers have recovered. Everything appears stable. But underneath, the structure is moving in a different direction. Costs are rising faster than perceived value. Designs are becoming more standardized. and the distinction between premium and affordable experiences is narrowing. That creates the paradox. Las Vegas is generating more money while becoming less differentiated. Properties invest in modernization to stay competitive, but in doing so, they remove the uniqueness that once justified higher pricing. At the same time, off-strip casinos maintain lower base costs, but begin introducing the same fee structures and design language. So both ends of the market start to converge. Different locations, different scales, but increasingly similar experiences. And that convergence is not immediately visible. It builds slowly, until the question shifts from "where should I go?" to "why does it all feel the same?" And when that question takes hold, it doesn't impact revenue overnight, but it changes behavior over time. And behavior is what the entire system depends on. So the real question is no longer whether Sunset Station is performing. It is. The numbers are stable, the operations are controlled, the model still delivers. The real question is what this model becomes as the system around it continues to shift. If the Strip continues to push pricing higher, and locals' properties continue to standardize, modernize, and layer in additional fees, then the gap between the two does not expand. It compresses. And when that compression reaches a certain point, the advantage of each model begins to weaken. Not collapse, but erode out quietly. Over time. Because Las Vegas was never built on efficiency alone. It was built on contrast, on identity, on the idea that every property offered something distinct. If that distinction continues to fade, replaced by controlled environments and predictable pricing structures, then the system enters a different kind of test. Not a short-term crisis, but a long-term question of sustainability. And that question does not get answered in a single quarter or a single year. It unfolds slowly across pricing decisions, across design choices, across how people choose to spend their time and their money. If you want to follow more deep dive investigations like this, make sure to subscribe, turn on notifications, and explore the next video on your screen.